Practical accounting, the better way to learn.
Hi, welcome back. Now we've covered the why should you care. Let's actually do some accounting right now. We're going to do Hot Dogs Are Us, a quick start. You have decided to start a business called Hot Dogs Are Us. You've noticed that other students on campus are walking around hungry in the middle of the day. So you've decided that you're going to open your own little hot dog stand. And here's your logo. John, why is there water coming off the dog?
Because he's hot. What else?
Oh,
dog.
Okay, we're going to define a balance sheet. A balance sheet is like a picture of where you're at. It's based on assets. Assets are things that the business owns, equals liabilities, which are debts, things that the business owes. And remember, this is all about the business, and equity, which is earnings plus investments made in the business. And then we have an income statement. This is like a picture because it's a point in time, the balance sheet. The income statement's more like a movie. It's over a period of time, and it answers the question, what just happened? So the first thing we're going to do is decide to start a business. Do we have any assets? John, do we have any assets when we decide to start a business?
Zero.
Zero. Do we have any liabilities or debts?
Hope not.
Nope.
No, zero.
Do we have any equity?
No.
No, not yet. Well, so we have nothing going on. Have we made any sales?
No.
No. Do we have any expenses or costs?
No.
And do we have any net income or profit, which is revenue minus expense?
Oh, no. Nothing.
No.
So why are we in business? We got nothing.
But deciding to start a business is not a transaction.
Oh.
Okay.
Oh,
okay. But most books start you out with beginning balances and all of these, but this is where you start from nothing. Let's move on and actually do a transaction.
Yeah.
Now we're going to take $20 of cash from our own wallet and you give it to the business called Hot Dogs Are Us to use. John, do we have any assets?
Sure. After we give ourselves our business money.
And what are we going to call that?
That's cash.
Cash. Yeah, cash. That's the first account. Assets are a group of accounts. Cash is a specific account. Do we have does the business own anything else?
Not right now.
Not right now. So do we have any debts?
No debt.
No debts. Now, do we have any equity?
Oh, yes. This is what I'm talking about. This is where $20.
$20.
Yes.
And what we're going to call that is contributed capital. Your book might call it common stock, but we're using the broader term. It really means the same thing. So total liabilities and total equity are the same. Our accounting equation, which is assets equals liabilities plus equity, is in balance on the balance sheet. So we're good to go. Have we made any sales, John?
No.
Do we have any expenses?
No.
No, we haven't used anything. So revenue minus expenses is zero. Nothing happening on the balance sheet or income statement. True, false. Every transaction income impacts the income statement.
That would be false.
That would be false. Here's the one that didn't. Okay, here we go. Third one. We're going to go to the store. What do we need? What do we need?
Hot dogs.
Hot dogs. Hot dogs. And buns. Yep.
Yep.
Should we get any mustard?
Oh, yeah.
Okay. How about onions?
Oh, most definitely.
Most definitely. We only have $15. We're only going to spend $15 though, so we're done.
So we can't have a chili dog like they have in New York, huh?
No, not yet. Not yet. So we're going to pay for this with cash. So how much cash do we have right now?
We have $20.
We have 20. and we're gonna spend 15. So how much cash do we have after this transaction?
We only have $5 left.
Only $5 of cash left. And now let's see, we could write like hot dogs, buns, ketchup, mustard,
Those are
and
condiments.
onions.
Yes.
Yeah, but I mean, that's starting to be a pretty long sounding name. What are we gonna call this, John?
We're gonna call it inventory. I don't know. We're gonna call it, what do you want to call it?
We're gonna call it inventory.
There you go.
This is our third account. Inventory is stuff you buy with the intention to sell, and we're going to value it at what we paid for it, which is $15. So our total assets have not changed.
That's right.
Okay. Do we have any debts?
Oh, no, we paid cash for this.
We paid cash for this.
We paid-
Do we have any equity?
Yes, we still have equity.
Yeah, we still have the equity. It hasn't changed from before, so we're gonna just keep that. Our balance sheet is still in balance. 20 equals 20. Now, do we have any revenue? Have we made any sales?
Oh, no,
No.
no.
Do we have any expenses? Now, I'm gonna pause right here and ask you guys, do we have any expenses? You might have said yes, but no, we haven't. All we've done, we haven't consumed anything. All we've done is exchange one asset called cash for another one called inventory. So we don't have expenses until we use them. So our net income is revenue minus expense is still 0. Moving on to our final transaction. We sell all the hot dogs and buns and everything for $25. How much cash do we have right now, John?
$30.
$30. And how'd you get that?
We have $25 plus that $5 in cash.
Right, we had $5 of cash to begin with. We just got 25 more, so we have $30 of cash. How much inventory do we have?
0.
Right, because we used it. So our total assets is 30 plus 0 equals 30. Do we have any debts, John?
No debt.
No debt. And we still have our contributed capital from before.
Ooh, what happened?
Oh, wait a minute. Our balance sheet's not in balance. So 30 does not equal 20. Let's move down here. Do we have any revenue? Have we made any sales, John?
We made, yes.
And how much was our sales?
We sold all of our hot dogs for $25.
Yep. Do we have any expenses?
Ooh.
Have
Yes,
we
we do.
used anything?
Folks, I don't know. Can you tell us? There's something missing here. Maybe that's that $15 we spent for the hot dogs.
Yeah, we used them, and now they've gone from being an asset, they've been consumed as an expense. And our net income or profit is revenue minus expense. We have $10 of net profit. And what we're going to do, folks, don't freak out here.
Ooh.
We're going to move this back up to the balance sheet. And we're going to call this retained earnings, which is really descriptive terms. It's earnings is profit. Retained means we've kept them in the business. And we're good to go. Now, that was sort of fast, folks.
Oh, no, it's good. It's the right time. So why are expenses and revenues part of retained earnings? And why does that increase our equity?
Well, remember, it's owner's equity. Who owns the profits?
The owner?
The owners. So we're gonna, it's not contributed capital. This is money that was generated through sales and profits. Okay, let's keep moving here because That sort of made me hungry.
Oh, man, it's a hot dog break. We'll be back.
You can get this Excel workbook and a whole lot more.
Stuff for free at practicalaccounting.com.
See you there.